Hello everyone, today we're going to talk about how to trade options, and we're going to cover a few basic things. So this is going to be a video mostly for beginners, just a basic understanding on how this transaction goes and what options are and what options do you have to trade options. Um, so we're just going to start with the definition of what a buy a call option is and how does it work. So just easy Google search, what is definition of buying a call, and how does buying a call option work. Call option gives you the right but not the requirement to purchase a stock at a specific price known as the strike price by a specific date at the option's expiration, that is the expiration date. Now, in order for you to get this right, you have to actually pay a premium, which the call seller will receive. I'm going to illustrate that real quick now with one stock that, well, actually a lot of airline stocks, I think they're going to do well. They're probably going to get a stimulus by the government, especially here in the US. And they kind of seem at a much lower rate. They haven't recovered much, so there's probably a good opportunity here to make some money. Of course, do your own research, and you basically decide what you want to do, as it is your money. But this is just something that I've done for myself. As you can see, I own 10 contracts with an expiration date of 2021 for July 16th. If you want to purchase options, call options, basically just click on here, choose an expiration date. They're shorter here, sometimes they're less expensive if the expiration is close by, and then the longer you go, it just becomes more expensive. But let's just say we want to purchase a call option from September 18. And just remember that call option means that you actually think that the price of the stock that we're talking about is going to go up at or before this expiration day, which is September 18th. It's pretty close, so that's just like a week from now. Okay, so let's just look at these numbers here real quick. Strike price. The strike price is actually the price that you're paying a premium for to guarantee you that you can purchase the stock at $14 a share on September 18th on the expiration date. Now, break-even price is different. It's $14.81 because in order for you to purchase this contract, you have to pay 81 cents, and the contract has 100 shares. So if you multiply that by 100, you pay $81. So you're paying $81 to guarantee you that you can purchase American Airlines stock at $14 on this expiration date. Of course, you want this to go as high as possible. Like if it goes over 14.81, then that's when you make more money. If it's below this and you haven't exercised, then you're probably not going to make any money. But it also depends on throughout this week, because the price can go to 14.3 like the first day, and there's some extra numbers here. They're called the Greeks. But that's a little bit more advanced, so we're just going to stick to this one here. But basically, you want the stock to go up from 14, hopefully to 15 or more, so you can create some money. Now, it also shows you that to break even, the stock price has to increase by 8.82%, and that's basically what the buy and call is. And if you want to buy it, just click on here. Basically say how many contracts you want to buy, just click continue. It's a long call, buy one. You can see the total cost here is $81. Just review order. It's going to take a while. I know the market is closed right now, but yeah, you basically just click submit and that's it, you're done. And what happens? So let's say you purchase this contract, and on expiration day, which is September 18, the price of American Airlines is $16. Well, good. You can actually buy 100 shares at $14 a share, and you're making a profit because you can sell them right away at $16. So basically you just make $200. But considering the fact that you paid $81 already, then you're making a total profit of $120. Okay, so next we're just gonna move on to what does it mean to buy put. So buying the put is kind of the opposite of buying a call, because when you buy a put, you basically want the price of the stock to go down. You don't think this stock is going to do well, or its company is overvalued, or you just hate the company, whatever you're thinking, or like using a strategy to make your trades. So the put option is a contract that gives the owner a right, not the obligation, to sell a stock at a predetermined price, and this is known as a strike price within a certain time period or expiration date, just like the other one. You don't have to own the underlying stock to buy or sell put. So we're going to go back here to Robinhood. I'm going to do the same thing with American Airlines. So we're just going to go here. Let's just look at the same expiration date, September 18th. I'm going to keep looking at this $14 strike price. So break-even price is $12.81. You're paying $1.19 for a contract, with because it has 100 shares, that will be $119. Let me actually remove this. Okay, so we're here. And this buying a put, because you're paying $119, that gives you the right to actually purchase this stock at $14, but your break-even price at this time would be $12.81, because 14 minus 119, that's equal to $12.81. So in order for you to make money on here, you'd have to, the stock would have to lose in value, and to break even, it has to go down by 6%. And basically, it just guarantees that you can actually sell the stock at $14 a stock on September 18th, which is actually really good, because if the stock price is below $12.81 and you can sell it at $14, that means that you're making money, because you can then buy it at a lower rate. So, but the only reason why this is $12.81 and not $14 is because you already paid this premium, and that is how this works. And the best thing about actually owning options and not stocks is that with options you already know the amount of money that you can lose or you're risking, while owning a stock, you know the company can go bankrupt and you can actually lose like the whole amount, and you can go bankrupt too. So let's say you're buying this stock. Let's say you're buying this this put right here. You're paying $119. That's for 100 shares, for the right for you to sell 100 stocks at $14 on expiration day. And the price didn't go down. The price went up, so it went to 15. So all you lost is 119. You know that. That's guaranteed. You don't lose more. While if you actually own 100 shares of the stock and the company went bankrupt, then you'd lose that $1,400, because 14 times 100 is 1,400. So you'd lose the whole amount of money. So that's how they're safer, but they're also involve greater risk, because you know, when owning a stock, you can actually keep the stock longer, unless, besides the case that it goes bankrupt. But you know how the stock prices goes down and goes up again. So you know, you can hold it and wait, and eventually or hopefully it will go up and the company do well. So you might be losing for now, but later you're gonna gain, and there is no expiration date. While with options, there is always an expiration date, and if it doesn't go the way you want it to go before that expiration date, then you will lose the premium. So that's the risky part of it. Okay, and then next we're gonna go on selling a call. So this is where it gets kind of complicated. Selling a call option, I actually Google searched this. This is from Range and Bull. There's an article from 2019. So this is a financial contract established between a buyer and a seller that provides the buyer with the right to purchase a security option at a specific price prior to the expiration of the contract. While the buyer does not have an obligation to buy the option, the seller is obligated to sell it at the strike price at any point prior to the expiration of the contract. So with call options, there's a few ways you can trade this, but you actually have to have the shares you're trying to sell call on. So the way that works is, let's say you have 100 shares and you're just selling a call to somebody. Let's just click on here, sell call. And we're gonna look at the same expiration date. Strike price is $14, break even $14.81. Chance of profit is really high, but you're basically gonna make $81 for this transaction. But you're gonna guarantee somebody that you're actually gonna sell them 100 shares at $14. Now, whether the price goes up or down, they have the right to exercise. And it is beneficial for you if the price actually goes down, and that's how you can make money. Because if it goes up, then you're actually going to have to sell those 100 shares at $14. Of course, you made 81 cents a share, which is, brings the price up to $14.81. But if let's say it goes up to 15, you have to sell 100 shares at 14, but now the price is 15, so you're basically just losing $1 per share. So you just lost $100 and only made 81, so you're like negative 19 already. But if the price goes down and the buyer most probably is not going to exercise, so he's not going to buy your shares at $14 because he can purchase them separately at 13.5, let's say, or $13. And this way you just made $81 and you still keep the stocks that you had. You don't have to sell them at a certain price unless the buyer exercises, which would be really weird. And then next we're just going to go to selling a put option. And it's kind of the opposite of selling a call option. This allows an investor to potentially own the underlying security at a future date and much more favorable price. Selling puts generates portfolio income to the seller and blah blah blah. So you keep the premium, and if it's not exercised, and by exercise means you just basically go through the contract. If somebody decides to buy them, they buy them. If somebody decides to sell them, and on the expiration date or before. So we're going to go back here and check how that works. So how does selling a put work and how is that beneficial? Let's say you want to sell a put, strike price $14, okay, keep the same expiration date. I'm not sure this is updated, but let's see. Okay, so strike price $14. Basically, somebody is offering $119, so for you to guarantee them that you are going to buy this stock at $14 on this expiration date, and you have to buy 100 shares. That's what one contract is. Click on here. Just keep that. Okay, so if you click on here, this will actually show you that you're agreeing to buy 100 shares of American Airlines $14 on or before September 18. If you aren't asked to buy American Airlines by then, you'll keep your collateral and the full $119 credit, which is cool. You can make $119. Share price right now is 13.61, and look at this. The contract is so you actually will buy this at $14 a share, which is more than what the actual price right now is. But because you get a premium of $119, which is $119, that ends up being beneficial for you if the the buyer actually makes you exercise or exercises his right away. So that's just not going to happen. But let's just look at something else. Let's say $13 a share. Okay, so if you guarantee somebody to buy 100 shares at $13 a share on this date, they're going to pay you 69 cents per contract, which is $69. So you can make $69 to buy the stock at a discounted rate on a future date, which is actually really close to where we are. Not exactly sure what the date is today. So in about a week from now, you make 69 bucks, and if you think that this company is going to do well, this is probably a good deal for you. So for me, I think that all the American airlines in general, I'm not talking about American Airlines as of this company that is on the screen right now, but I'm talking about Southwest, Delta, United, Spirit Airlines, whatever. I think their stock prices are kind of low right now, and they've been creeping up, and I believe with the flights picking up, they're definitely gonna, increase their revenue and have more sales, and of course their stock prices supposedly going up. So yeah, I think this is a good deal. You can just purchase this company. I know there's been some rumors about some of these companies going bankrupt. I don't think this is going to happen, as the United States government is also talking about giving them some financial aid in the following weeks or month. Which kind of makes sense because our president wants to win the re-election, and he kind of has to be on good terms with everybody. So he's trying to do whatever he can to help whoever he can, so he can hopefully for him get re-elected. But yeah, I think this is really good. There's a okay chance of profit. There's some risk involved, of course, because the price can go below 13. But your break-even price is 12.31 here. So unless the price goes below 12.31, at least if it goes to 12.31, you're going to break even. If not, you're going to make some extra money. Yeah, that's pretty good. I think for now. I don't think I have anything else, or I don't think there's anything else that I can think of. But if you guys do have any questions, please let me know in the comments section. Or for all of you that know me personally, you can definitely send me a text message or contact me through other ways. But don't forget to subscribe. If you like what you see, of course, you can share it with your friends as well. And I've been really busy, so I'm gonna try to make videos more often, but I'm too busy studying other things. And hopefully once things cool down a little bit on my end, we might be able to actually make more videos more often. Anyway, I'll see you on the next video, and don't forget to subscribe. Thank you so much.